Bam, gotta set my timer because you know my millennial be like, yo Jay, cut it short. Why? Why you make them so long? It takes me too long to upload it. God, and he pouts and then goes away in his electric vehicle. You know, big nerd. Dude's huge. He's like this. Yo Jay, why are you talking so much trash? All right. So let's talk about basic forms, basic whole life premiums. All right. Look, this theme right here is going to stay with us across the board. Like there's only a couple of ways we can pay things. All right. So look, check this out. The first one, highlight straight whole life. Guys, this is when they talk about whole life insurance. If they don't give you any adjectives talking about some kind of special component of the policy, basic, boring, level, straight, these policies mature at age 100, which means the premium is calculated to for you to make it until you die, okay, or turn 100. That's it. Understand that. Straight whole life. You want $1 million policy, it's X amount of dollars a month. You are paying every single month until age 100. Straight life. Highlight pretty much the entire section here. Straight whole life is a whole life insurance providing permanent protection with level premiums from the time the policy is issued until the insured's death or age 100. Age 100, when the policy matures. Now, if the most basic way to issue the life insurance policy, a whole life, is calculated with premiums to go to age 100, what do you think limited pay means? It means you're going to pay your premium for a term less than till age 100. Is it going to be more expensive? Yeah. Because right now, let's just say I want to jump into a whole life policy. I'm signing today. Well, if I want one of these straight level doo-doo policies that, you know, my grandma would have bought, not one of those sexy, flexible, universal policies that's like can change everything. But with this limited pay, I go ahead. I don't want to pay till age 100. All right, I want a 20 pay whole life policy. I'm paying up the entire premium in whatever time frame I choose. So it's kind of like a term. It's giving me a whole life worth of coverage, but my payments are on a term. Okay, so here, limited pay whole life, highlight in that first sentence. Limited pay whole life policies have level premiums limited to a certain period. And then underline in that bracket there, less than life. How long is life? Age 100. And then right under that, 20 pay life policy. Premiums are payable for 20 years. Next page over on 92 at the top. The name of the policies denote how long the premiums are payable. That's it. Once again, you go down a couple of lines, you see it. 20 pay life. How long you paying premiums for? 20 years. Now, if straight whole life, you make premiums until the policy matures, and limited whole life, you choose the time frame you're paying the premium, what do you think single premium whole life funding is like? One single lump sum premium completely funds the policy. Highlight this. Single premium whole life, and then go to that bold right there. Single premium whole life, one time only premium payment at the beginning of the policy period. Done with that. Now, next page, you see this modified endowment contract 542? I want you to highlight that headline, modified endowment contract. Sometimes modified is a good thing, right? Like David here. You know, he likes all those little rice burners, you know, those little cars and stuff. He's got one of those little four bangers with, you know, those the mufflers like driving around scraping. Yo, sometimes modified can be a bad thing, right? If you got one of those static, basic doo-doo policies and you contribute more money to the policy than was scheduled, you modified it. Now the problem is that you can't, if you have one of those old static doo-doo policies, the way it is issued is the way it stays, okay? So if I add more money to it, I modify the policy. Well, if I don't increase the benefit, I change the term of the contract. I lost my tax favorable status. A modified endowment contract is a bad thing, like that little rice burner that David doesn't drive. He doesn't really drive one of those. he doesn't. He's back there like, yo, that's messed up, Jay. Why are you telling everybody? He's like, you know that's your people down there in Kissimmee running around. I'm like, what you mean your people? You know, I got this African dude talking trash about Puerto Rican dudes and Middle Honduras. Come on, man. What are we supposed to be teaching these people here? Anyway, right. So modified contracts are a bad thing. What I want you to do is go all the way down to that page, all the way down on the bottom of that page on the modified endowment contract, last paragraph, and the first line's right there. If the policy is deemed a MEC, a loan or with, next line down, a loan or withdrawal taxed first as ordinary income and second as a return of premium, you lose all your tax advantages. The reason being is that if you chose a policy with a structure to it and you modify the structure, it looks like you were trying to hide money or, you know, create a tax sheltered vehicle with, you know, wrong conditions. It's not the right policy for you, all right? Go over to 97. First line, highlight 10% penalty tax. Next line down, towards the end of that sentence, before age 59 and a half. That 10%, look, when it comes to penalties, and if we're ever going to identify a penalty, it's going to be 10%. Unless we're talking about grandmas and grandpas when it comes to Medicare, and then it's 1%, right? And just think about that, man. No one can get, don't even try to give a grandma and grandpa a 10% penalty. You go ahead and give them that 1% slap on the wrist. Now, next paragraph down, you see that big bold 3 lines down, 7-pay test? That's how they find out whether or not you messed up your policy, your whole life policy. And so the way it works, highlight 7-pay test, same sentence at the end. Total amount of policy owner pays into a life contract. And then right after that, exceeds level premiums on the next line down, payable. The policy is a MEC. What that means, you put your policy in play today. If any time during the next 7 years you contribute more than that premium schedule says you need to contribute, you modified the contract. You messed it up. You're now looking at penalties if you withdraw. It doesn't work anymore, right? So that's all you need to know. You contribute too much money to a doo-doo straight whole life policy, basic. It's not what it was designed to do, right? Just like that car. You weren't designed to put big rims and that loud muffler on that thing. Make me want to throw eggs at him as he drives by. Anyway, right? So the modified is bad. 10% penalty, 7-pay test. That identifies if you overfunded it. Now let's go over to page 98. 553 joint life policies. Take that first line. A joint life policy is one that covers 2 or more people, as Julio would say, dos personas. Right, Julio? Dos. Yeah, see that? While I'm in class, it's funny because I'm over here as supervising official for a school, right? So the DFS thinks that I'm supposed to look out for my instructors. I'm supposed to make sure they're teaching you the right thing. I don't understand like every 7th word Julio says. He could be out there trying to sell you Amway for all I know. Yo, man, if Julio tries to sell you guys Amway, DM David, all right? I am David to you on Instagram. You see him there, swole, like, yeah. Yeah, I'm telling you, man, think I'm kidding. Watch when I get up there, they're going to see David in his breakdancing pants.
Yes.
All right, so look, joint life policies covers two or more people. Next line, right under that two or more people, at the end of the second line, it pays a death benefit when one of the insured dies. That's all we need there, right? Go down to the second paragraph there, highlight that last survivor policy, and then next line down at the end, pretty much after that policy on the next line, benefit is paid upon death of the last surviving insured. So just think about it, joint life, that means you take me and Kelly. So if you're here right now, Kelly probably helped you get into the class because I don't do customer service. Julio, let me introduce you guys. This refugee right here is my man Julio Ramos Jr., Medicare extraordinaire, bilingual. He's teaching me how to speak Spanish after all these years. But he was the guy showing you all that fuzz over there, hanging out in the hot tub. I don't know. This is Miami. I don't say anything out here because these Miami people don't know how to act. All right. I just went in Miami, act like the Miamians, right?
When in Rome.
All right, fam. See you later.
Yes, sir.
All right. Have a good one. All right. FYI, if you're wondering how I can come out here in flip-flops and socks, swing on a pole and have my boys in the hot tub while we're trying to teach you, it's because at no time did the Department of Financial Services or the CFO say I had to come up here and have a stick in my rear and act like Bueller, Bueller, Bueller. I can't do that, guys. I can't do that. This is the business of insurance. From anywhere, actually, at the end of this course, next week I'll be in Punta Cana. Can't make this stuff up. We'll be shooting live with the class. Why? Because Kelly doesn't like starting the day early, so we know we don't have no excursions before 11 o'clock. Might as well host class. But shh, shh, don't tell her I said that. She don't watch my content. She'll never know. So look, if we skip over on to the next page. Yo, Millennial, what's my time? 12 minutes. And we just finished joint life policies. All right. Let's pause right here, and then the next clip, we're going to come back to non-traditional life policies. And I'm going to go ahead and say what's up to my man, Neil Schwabe. What's goody good? MGA with United Healthcare. All right, peace.